if you're a central bank, there's really only one choice, and that's gold. So the central banks are going to be loading up on gold as they're unloading on U.S. dollars and treasury debt. So gold and silver should keep rising, even if there's a slight buy the rumor, sell the fact move on a rate cut. But again, I wouldn't even wait for that. Don't even try to be tricky. As I've been saying, you got to buy gold and silver. You don't wait. You just buy it. If you don't have it, you need it. And if you have some, chances are you need more.
Rate cuts usually get celebrated as good news. Stocks cheer, bonds rally, and people assume cheaper money will fix everything. Peter Schiff says that's a dangerous illusion. On his show, he points out that rate cuts aren't the victory, they appear to be the Fed's confession that inflation is winning. Schiff explains it this way: bonds might look strong ahead of cuts, but the setup is a trap. Lower rates mean weaker dollars, less appeal for foreign bond buyers, and a higher inflation outlook. That combination pushes long-term interest rates up, including mortgages, even as the Fed tries to push short-term rates down. The result? A bond market that looks more fragile, not less. Gold and silver, however, operate by a different logic. Schiff says the metals haven't even begun to reflect the scale of the monetary shift underway. Gold just hit an inflation-adjusted record, and silver is trading near levels last seen more than a decade ago. Both, he argues, have much further to run. Schiff notes they're not holding on to dollars or treasuries when the Fed is deliberately fueling inflation. They're accumulating gold instead, reinforcing the long-term case for owning it. Meanwhile, mining stocks are confirming the move. The GDX, which tracks the largest gold miners, is already up 103% this year, and Schiff expects the strongest quarter is still ahead. For him, the writing is on the wall. Bonds are the trap, metals are the escape. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
My forecast, again, is that when we get those highly anticipated rate cuts, it is a buy the rumor, sell the fact, and the bond market goes down, and long-term interest rates, including mortgage rates, go up. And that is going to be very frustrating for the Trump administration and for the Fed. Now, some of you may say, well, gold is rallying. Silver hit a new 14-year high today, finally. Gold didn't. I mean, gold has been a little subdued the last couple of days. It's trading around $3,635. Oh, by the way, just this week, gold finally hit an inflation-adjusted all-time high. Now, not real inflation, but whatever the CPI adjustment is. We finally took out the $825 high from 1980. But this is not the end of something. This is the beginning of something. We are just getting started here in gold and silver. But gold and silver are also rising into this rate cut. And you may say, well, Peter, if you think that it's going to be a buy the rumor, sell the fact for bonds, why wouldn't the same hold true for gold and silver? Maybe gold and silver will sell off on the rate cut. Possible. It's possible. But I don't think it's that probable, because even though gold and silver have rallied, I don't think they've rallied nearly as much as they should. But also, there's a big difference between the gold trade and the bond trade. Rate cuts are bearish for bonds. Rate cuts are inflationary. It means the Fed is turning its back on 5% inflation. That's probably going to become 6 or 7, and is instead choosing to die on the hill of employment and fight that battle. To hell with inflation. So once the Fed does that, that's a big signal to get rid of your bonds, right? Because the biggest destroyer of the value of bonds is inflation. And of course, rate cuts mean a weaker dollar. So why should foreigners want to buy our bonds if we're going to repay them with dollars that are worth less in their own currency than the dollars they loaned us, especially when we're reducing the rate of interest that we're paying them? So these rate cuts are bearish for bonds. So even though bonds have rallied on anticipation of the cuts, the event they anticipated is actually bad for bonds. So they shouldn't be rallying. So that's another reason why they should sell off and why they probably will sell off. On the other side, rate cuts alongside of rising inflation are the most bullish thing you could have for gold. So gold should be rising in anticipation of these cuts, and it should keep rising following the cuts. Because as people want to get out of their dollars and get out of their treasuries and mortgage-backed securities and whatever else has got a dollar coupon and a dollar principal payment attached to it, what are they going to buy? Well, if you're a central bank, there's really only one choice, and that's gold. So the central banks are going to be loading up on gold as they're unloading on U.S. dollars and treasury debt. So gold and silver should keep rising, even if there's a slight buy the rumor, sell the fact move on a rate cut. But again, I wouldn't even wait for that. Don't even try to be tricky. As I've been saying, you got to buy gold and silver. You don't wait, you just buy it. If you don't have it, you need it. And if you have some, chances are you need more. Look at gold stocks, right? I've been talking about these stocks now. I've been pounding the table on these stocks. So the GDX, right, which is the index of the biggest gold stocks, is now up 103% on the year. And the year ain't over. 103%. This is September. We haven't even hit the fourth quarter yet, which I think will be the strongest quarter of the entire year. And we haven't even gotten to it yet. We're up 103%. Now the GDXJ, which has some smaller mining companies, not the really tiny ones like some of the ones that we got at my gold fund, but now these ones are moving. So now the GDXJ is outperforming the GDX. It's up 111% on the year. 111%. Now, compare that to the S&P, up 12.25%. That's nothing. The GDXJ is up 10 times as much as the S&P 500 this year. 10 times as much. Do you think they talk about that on CNBC? No, they don't. They don't talk about that at all on CNBC. Now, the 12% return on the S&P, that's about the same as on my foreign bond fund. So my clients this year just buying short-term foreign bonds are making as much money as people taking a risk and buying the S&P 500. Now, if you look at my dividend payer strategy, my foreign dividend payers, conservative dividend paying stocks, it's up better than 43% on the year. 43, close to 4 times the return on the S&P 500. Now, this is the first time in many, many years that fund has beaten the S&P, but I think it's the beginning of a long trend. But what's really significant about the gold stocks, I did the math. Over the past 10 years, the S&P has returned average annual compounded gain of 14.91%. Now, that's a great return over 10 years, 14.91%. It's much more than the historic average, but that's a big return. Compare that to the GDX, which is up compounded over 10 years, 19.33%. So about 25% greater return compounded over 10 years in gold stocks. So during those 10 years, a lot of people are making fun of me. Peter's this perma-bear. He's telling people not to buy the U.S. stock market. That's correct. I told people not to buy the U.S. stock market. I told them to buy gold stocks instead of the U.S. stock market, and now they're better off, at least if they started 10 years ago. Now, they're also better off if they started 3 years ago. There are a lot of time frames where they're better off. In fact, if they started 3 years ago, they're way better off, even more so than if they started 10 years ago. Now, of course, the problem is some people didn't have the patience to wait it out, right? There were people who bought gold stocks on my recommendation 10 years ago who sold them last year. That was terrible. They threw away a winning hand. I mean, I tried my best to prevent it. Whenever one of the guys from Europe Pacific Asset Management or told me, hey, this guy is selling, I called him up personally to try to talk him out of it. And, the reason everybody gave me, look, I'm waiting so long, and now Trump is president, he's going to do all this. I'm tired of holding these gold stocks, and I had record withdrawals from the Europe Pacific Gold Fund, EPGIX, in the fourth quarter of last year. And then in the first quarter of this year, people sold the fund. And they didn't just sell my fund. People were calling up the brokers that I work with and selling their individual gold stocks at the end of last year.
Peter Schiff argues the Fed has boxed itself into a corner. Back in the zero-rate QE years, inflation was running below 2%. The Fed used that as justification for extreme stimulus near-zero rates and trillions in bond buying. Fast forward to now. Inflation is well above target, yet the Fed is still cutting. By its own logic, Schiff says, the Fed is more off course today than it was then. At the same time, the credibility of government labor data is fading. Schiff points to the endless revisions numbers that first paint a rosy picture of job growth, only to be scaled back months later. The labor market has been weak for years, one reason discontent boiled over into Trump's 2016 victory. But the Fed keeps leaning on these overstated jobs figures to justify cuts. On the other side, inflation data is massaged to look cooler than it is. Strip away adjustments and substitutions, and prices are rising much faster than official numbers suggest. That creates a distorted picture, a supposedly fragile labor market needing support, paired with manageable inflation. Schiff says the Fed's original mandate makes inflation control the top priority because unchecked inflation destroys jobs too. Yet instead of fighting price pressure, the Fed is doubling down on cuts. In his view, it's a dangerous inversion, ignoring real inflation to chase a weak employment narrative, guaranteeing more pain ahead. Let's get back to the interview.
Earlier this morning, we got the release of the highly anticipated August consumer price data. And the reason that it's been so highly anticipated is because everybody is now betting on rate cuts starting next week, and a benign CPI report was the last obstacle. I mean, maybe if this thing came out way hotter than expected, somehow it may have rained on the rate cut parade. So everybody was anticipating eagerly this release just to make sure that the rate cut train wasn't going to get derailed. And we got the number, and it actually was slightly worse than expected, but not enough worse, to rain on the parade. The forecast was for a increase of 0.3. That's the headline number. The actual increase was 0.4, so 1/10 hotter. The rest of the report was in line with the year-over-year CPI up 2.9, but of course that's hotter than the 2.7 in the rearview mirror for the prior month. Ex-food and energy, month-over-month, 0.3 increase, matches the prior month and as expected. And year-over-year core, 3.1. And that's what was expected, and that's what we got last month. Now, if the Fed is being honest about its 2% inflation target, they're clearly well above it. They're more above their target than they ever were below. If you look at when the Fed was doing QE with 0% interest rates, because they were below 2%, they were below it by less than they are above it now. Yet now, apparently, it doesn't matter. Even though they're further away from the target in the other direction, they're able to cut rates. Now, if you annualize 0.4, that's 5% inflation. 5% is a big number. Shouldn't the Fed be afraid that maybe this 5% is going to turn into 6% instead of 2%? Plus, it's the CPI. It's not accurate. I'm finally hearing in the mainstream media a lot of talk now about, hey, maybe the data we're getting from the government on labor, on jobs, maybe it's not accurate. All these revisions, and I'm going to get to that. But the number is unreliable. Numbers are unreliable. They're saying maybe the labor market is actually weaker than the data suggests. Well, duh. Yeah, I've been saying that for years, right? It is weaker, right? By design, the government data sugarcoats everything. So when it comes to the stuff that's supposed to be low, right, like unemployment, then you get low data. So yes, the labor market has been and is much weaker than the data. That's why Donald Trump is president. I said that before he was elected. It was a weak economy. That was the reason that people voted for Trump, because Trump promised change, and it was a pocketbook election. In fact, the exit polls were all about the weakness in the economy, and that's why they voted for Trump, right? So we didn't have a strong economy the way the Democrats or Wall Street were spinning it, We had a weak economy. But now you're actually seeing some people saying, yeah, the labor market is actually weaker than we thought, so the Fed should be cutting. Except they're only looking at one half of the equation. On the other side, it's the inflation data. Nobody is talking about the fact that this data is wrong too, except in the other direction. The problem with the inflation data is that it's too low, right? The CPI has been rigged. It has been engineered to come out with a smaller number than the actual increase in prices, which again doesn't even measure inflation, which is the expansion of money and credit. It measures the effect of inflation, which is an increase in prices, but it deliberately understates the degree to which prices are going up by design. You really kind of have to double whatever the official number is to get something close to the actual rate. So if inflation is right now annualizing at 5%, then it's probably 10%, which makes a lot more sense to me than 5%. But here's the point I'm making. If you're going to say that fake jobs data argues for a rate cut because the jobs market is actually weaker than the data, well, inflation, that data is underestimating already high inflation. So that argues for a rate hike. Inflation is being underreported, just like the strength of the job market is being overreported. We have a weak labor market, but we have strong inflation. Now, when you have those two things, the weak labor market doesn't trump the strong inflation. Although I guess if you're Trump, it does trump it. But politically speaking, the Fed has got no choice now. They're boxed in. They're cutting rates. They're on this trajectory, even though rate cuts are not supported by the data, because the Fed should be hiking. Despite the weakness in the labor market, inflation is the primary goal. In fact, at one point, there was only one mandate. I forget when they added the second mandate. And if you talk to the Fed chairman, even Powell has said this, the best way to achieve the mandate of full employment is to make sure they tackle inflation. Because if inflation gets out of control, then the Fed admits they can't control the economy or employment. So they've always said the best way to achieve our second goal is to make sure we achieve our first goal. So the primary goal of the Fed should be to fight inflation. So if you've got a problem where inflation is too high, but the job market is too weak, you've got to err on the side of tackling inflation. But that is not what this Fed is about to do.
What stands out in this moment is how the very tools once promoted as stabilizers are now accelerating instability. The pattern is clear. Cheaper money props up appearances in the short term, but beneath the surface it corrodes trust, weakens currency strength, and hollows out the market's foundation. Precious metals, long dismissed as relics, are quietly stepping back into their historic role as guardians of value, while bonds look more like snares than safe havens. Add to that the mounting cracks in economic data, and it becomes difficult to argue that policy is steering toward balance. It looks more like it's buying time at the cost of credibility. The real issue is whether investors and policymakers will recognize the warning signs before the cycle delivers a harsher reckoning, or if the shift to tangible assets will only become obvious once confidence in paper promises has already broken. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.